Welcome to Duo Reads, where we decode deep ideas and break down big books one page at a time. Today, we're exploring a book designed to give you, well, unwavering confidence in one of life's most crucial areas, and your finances. We're talking about Unshakeable, your financial freedom playbook. And this isn't just about crunching numbers. It's really about providing a clear path, a path to financial success, and maybe more importantly, genuine peace of mind. Freeing you from fear and uncertainty in a world that, let's face it, often feels pretty bewildering financially. What's so compelling about Unshakeable is its timeliness. It feels very relevant now, yet it's built on these truly timeless principles. It comes highly recommended by experienced financial leaders like Steve Forbes and Jack Bogle, the founder of Vanguard. And what makes it kind of unique, I think, is this blend of really practical financial strategies with these deeper insights into, well, human psychology. Because as the book powerfully illustrates, your mindset is just as important as your money. Maybe even more so sometimes. When we look at today's financial landscape, it's certainly...
Right. We've seen these experimental policies like negative interest rates in major economies, something historically rare, maybe even unprecedented over 5,000 years, the book mentions. For many people, this kind of uncharted territory makes navigating personal finance feel incredibly complex, overwhelming even.
It absolutely does, and that's precisely where Unshakeable tries to step in. The book immediately pinpoints two significant challenges, two ferocious foes, as it calls them, standing between you and financial well-being. Fear and fees. Let's maybe tackle fees first, because they're often this silent drain on your wealth.
Right. It's pretty amazing how these hidden costs can literally strip away, hundreds of thousands of dollars from your nest egg over time. It's all thanks to the power of compounding working against you.
Exactly. Every single dollar that goes to fees is a dollar that can't grow for your future. It's gone. And the shocking reality is most people don't even realize it's happening. There was an AARP study mentioned that found a staggering 71% of Americans believe they pay no fees for their 401ks. Zero.
Wow, 71%. That's huge.
Yeah. And 92% have basically no idea what they actually pay. To put that into perspective, imagine the market consistently returns, say, 7% over 50 years. A long time, right?
Yeah.
An initial dollar could grow to about $30. Pretty good. But if you're paying what seems like a small 2% annual fee, which is pretty typical in some actively managed funds, your return effectively drops to 5%. And that same dollar, it only grows to $10 over those 50 years.
$10 instead of 30.
Yeah. You've just forfeited 2/3 of your potential wealth just to fees. It's massive. And another kind of insidious issue the book exposes is this 5-star trap.
The 5-star trap, what's that?
Well, mutual fund companies, they tend to quietly close down their underperforming funds, the ones that did badly, and then they heavily market the few that did well, the 5-star winners. So it creates this misleading perception that they're consistently successful.
Okay. So you only see the winners.
Exactly. And the real cost of a fund isn't just that advertised expense ratio. It also includes hidden transaction costs, cash drag money sitting uninvested, and even tax costs in taxable accounts. It all adds up to way more than most people think.
Okay, so fees are definitely a silent killer. That's clear. If fees are one major hurdle, the other you mentioned is fear. That paralyzing fear of market crashes, which often keeps people from investing altogether. But I want you to think about the alternative. What's the actual cost of staying out of the market?
That's such a crucial question. And here's a fascinating fact from the book. Since 1900, there's been a market correction that's a drop of 10% or more on average every single year.
Every year? Really?
Pretty much, on average. So these aren't some rare black swan events. They're a routine part of how markets function. And the good news, historically, these corrections are surprisingly short-lived. They average only about 54 days.
54 days. Less than 2 months.
Exactly. Less than 2 months. Suddenly, they don't seem quite so terrifying, do they, when you put it like that?
Yeah, that reframes it quite a bit. Still, despite this, the illusion persists, right, that someone, somewhere, can consistently predict these market movements. It reminds me of what the physicist Niels Bohr said. Prediction is very difficult, especially about the future. Seems obvious, but we forget.
We do. And the investing legends agree.
Like Jack Bogle, right? Didn't he have a great quote on this?
He did. He said something like, in 65 years, I not only have never met anybody that knew how to do it market timing, I've never met anybody who had met anybody that knew how to do it.
Huh. Okay, so probably not a winning strategy then.
Probably not. And Warren Buffett famously quipped that the only value of stock forecasters is to make fortune tellers look good. The studies just back this up completely. To succeed at market timing, you'd need to be right, like an impossibly high percentage of the time, 70, 80, even 90% according to some studies. Research consistently shows that simply staying invested, buying and holding the market through something like an index fund outperforms the vast majority of these timing strategies.
So beware the merchants of doom, as the book calls them.
Absolutely. They often thrive on creating fear, and if you look back, their dire predictions have almost always proven wrong again and again. And if you look at the bigger picture, the long-term trajectory of the market is, well, far more optimistic. Take the period from 1980 to 2015, despite average dips within each year of over 14%.
Okay, so big swings even within the year.
Yeah, significant swings. But the S&P 500 still delivered a positive return in 27 out of those 36 years.
27 out of 36, that's what, 75% of the time?
Exactly, a 75% win rate, despite all the scary headlines along the way. And this upward bias isn't random. It's driven by the natural expansion of the economy, increasing corporate profits, productivity gains, population growth, and just constant innovation.
It ties back to that Buffett quote again, doesn't it? About betting against America.
It does. For 240 years, it's been a terrible mistake to bet against America, and now is no time to start. That's the essence of long-term optimism.
Okay, so corrections are normal, market timing is futile, and the long term looks good. But what about the really big ones? The bear markets. A drop of 20% or more? They sound scary.
They do sound scary, and they feel scary when you're in them. But the book points out they also happen fairly regularly, roughly every 3 to 5 years on average. And yes, they can see significant declines, sometimes over 30 or even 40%.
Ouch.
Yeah, ouch. But here's the critical point. Bear markets don't last. They feel like they will, but they don't. Their average duration, historically, only about a year. Sometimes more, sometimes less, but on average, a year.
Only a year?
Yeah.
That's surprising. You think of something like 2008 feeling like it lasted forever.
It felt that way. But think about it. The S&P 500 plunged dramatically, yes, but then it hit its bottom in March 2009. And in just the next 12 months, it soared nearly 70%. 70%.
Okay.
And since that bottom, it's climbed over 260%. So the recovery can be just as dramatic as the fall. And this is precisely when the biggest opportunities often emerge. When pessimism is absolutely rampant, when everyone thinks it's the end of the world.
Like buying when there's blood in the streets.
Sort of, yeah. The book uses the example of Citigroup stock during that 2008 crisis. It plummeted from like $57 a share all the way down to just 97 cents. Imagine that.
97 cents.
Yeah.
Almost worthless.
Almost. Yet, within just 5 months, it rebounded to $5 a share. That's roughly a 500% return for anyone brave enough, or maybe crazy enough, to buy when everyone else was despairing.
That takes guts.
It does. It's psychologically incredibly challenging, but the rewards for acting counterintuitively when others are fearful can be immense. And here's maybe one of the most crucial points about the cost of trying to avoid these downturns, the cost of sitting on the sidelines. Missing even a few of the market's very best trading days can severely, devastate your long-term return.
How much of an impact are we talking?
Okay, get this. From 1996 to 2015, if you simply stayed invested in the S&P 500, your average annual return was about 8.2%. Not bad.
Right.
But if you missed just the top 10 trading days over those entire 2 decades, just 10 single days, your returns were nearly cut in half. They dropped all the way down to 4.5% annually.
Wow. Just 10 days makes that much difference.
A massive difference. It really drives home the point. Time in the market consistently beats trying to time the market. Just being there is most of the battle.
Okay. Understanding these dynamics, fees, fear, volatility, the cost of missing out, it definitely puts you in a more powerful position mentally. But how do you translate that knowledge into a concrete strategy? Something you can actually use.
That's where the book introduces what it calls the Core 4.
The Core 4.
Yeah, these are fundamental decision-making principles. They were distilled from interviews Tony Robbins did with over 50 of the world's most successful investors. So these aren't just theories, they are truly battle-tested approaches.
All right, let's hear them. What's the first one?
The first core principle sounds deceptively simple. Don't lose money.
Don't lose money. Okay, easier said than done, right?
Well, yes and no. While most average investors focus on maximizing gains, trying to hit home runs, the world's best investors are actually obsessed with minimizing losses, protecting their capital. The math explains why. Think about it. If you lose 50% of your money,
Yeah.
You need 100% gain just to get back to where you started, just to break even.
Right, double your money just to get back to zero.
Exactly. And that can easily take years, maybe even a decade, depending on the market. This concept is absolutely central to investing legends like Warren Buffett. It's why figures like the hedge fund manager Paul Tudor Jones aim for what they call asymmetric risk reward.
Asymmetric risk reward.
Yeah, like risking $1 with the potential to make 5. They always prioritize protecting the downside first before even thinking about the upside.
Okay, protect the downside. Principle number 1. What's next?
Once you've focused on not losing, the second principle is tax efficiency.
Taxes.
Yeah.
The other certainty in life.
Pretty much. The mantra here is it's what you keep, not just what you earn. Think about actively managed mutual funds. They often involve frequent trading, buying, and selling. This activity can trigger short-term capital gains, and unfortunately, those gains are taxed at your higher ordinary income tax rate.
Not the lower long-term capital gains rate.
So taxes can slash your actual take-home profits by 30%, 40%, sometimes even more, depending on your bracket.
Oof, okay.
And this really highlights the immense value of using tax-advantaged accounts whenever possible, things like your 401ks and IRAs. Keep Uncle Sam's bite as small as possible.
Makes sense. So don't lose money, be tax efficient. What's number 3?
Core principle 3 is diversification. Now, this one sounds familiar, right?
Yeah, don't put all your eggs in one basket. We've all heard that.
We've all heard it, but the book argues few people truly apply it comprehensively. It draws on insights from Burton Malkiel, the Princeton professor famous for a random walk down Wall Street, and it highlights 4 crucial ways you need to diversify effectively.
4 ways, okay.
First, diversify across different asset classes.
Right.
So not just stocks, but also bonds, maybe some real estate, other alternatives.
Got it. Mix of it.
Second, diversify within those asset classes. Don't just own one stock, even if you love the company. Own a basket of them.
Right. Avoid concentration risk.
Third, and this is often overlooked, diversify across markets, countries, and currencies. Go global. U.S. investors especially tend to have a strong home bias, putting most of their money in U.S. companies.
Yeah, that feels comfortable, I guess.
It feels comfortable, but look at Japan's lost decades, where their market went nowhere for ages. Or think about the U.S. market's own lost decade from 2000 to 2009.
Right, the dot-com bust and then the financial crisis.
Exactly. During that time, many international stocks actually performed quite well. So being global helps smooth out the ride.
Okay, global diversification. What's the 4th way?
The 4th way is to diversify across time. And this is done through dollar cost averaging.
Dollar cost averaging. It just means investing regularly, right? Like every paycheck.
Precisely. Systematically adding to your investments over time, regardless of whether the market is up or down. This automatically makes you buy more shares when prices are low and fewer when they're high. It reduces risk and smooths out those market fluctuations.
And that's powerful over the long run.
Incredibly powerful.
Yeah.
The book tells the amazing story of Theodore Johnson, a UPS worker. He never earned more than $14,000 a year back then.
Wow, modest income.
Very. But he consistently saved and invested 20% of his income, having small amounts withheld from his paycheck to buy company stock. Over decades, he accumulated over $70 million.
$70 million from that salary. Just by being consistent.
Just by being consistent and diversifying across time. It's a stunning example of the power of systematic investing.
Okay, those 4 diversification methods are key. Asset classes, within classes, globally, and over time. What's the final core principle?
For 4th and final core principle is really understanding the main asset classes you're investing in. Know what you own and why.
All right, give us the quick rundown. Stocks.
Stocks, or equities, they represent ownership in companies. Yes, they can be volatile in the short term, lots of ups and downs, but historically, they've offered impressive average annual returns, somewhere in the ballpark of 9–10% over the very long haul. Remember that point about the economy expanding? As companies grow profits and innovate, over the long term, the stock market news will likely be good.
Okay, long-term growth potential, but bumpy ride. What about bonds?
Bonds are simpler, essentially. They're loans. You're lending money maybe to the government with treasury bonds, or to cities with municipal bonds, or to companies with corporate bonds. They are generally considered safer than stocks. They provide steady income through interest payments. And historically, bonds have delivered positive returns in most calendar years, maybe around 85% of the time.
So more stability, less potential upside.
Generally, yes. They can be a great component for more conservative investors or for money you might need in the shorter term, say 3–5 years. Or, as the book suggests, they can provide dry powder stable funds you can use to buy stocks when they go on sale during those market downturns.
Makes sense. What about other stuff, like alternatives? gold.
Yeah, alternatives cover anything outside of traditional stocks, bonds, and cash. The book touches briefly on assets like gold, but it includes a healthy dose of caution, echoing Warren Buffett's view. He once quipped something like, "Gold gets dug out of the ground. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility."
Huh. Fair points.
Historically, traditional productive assets like stocks, bonds, and income-producing real estate have generally provided better long-term returns than just holding gold.
Okay, so we have the core 4 principles.
Hmm.
But putting them into practice often means working with someone. How do you find a financial advisor you can actually trust?
That's a huge concern, and the book provides some really crucial advice here on finding a true fiduciary, someone legally obligated to put your interests first.
Because not everyone who calls themselves an advisor is one.
Exactly. It warns specifically against advisors who might claim to be fiduciaries, but are actually dual registrants.
Dual registrants, meaning
Meaning, they can act as advisors sometimes, but also as brokers, selling specific financial products for a commission. This creates a huge potential conflict of interest. Are they recommending what's best for you or what pays them the highest commission?
right, that's a conflict.
And these arrangements can lead to hidden fees, too. Sometimes they even layer on extra charges for using a preset model portfolio when really nothing additional is being actively managed for you.
So how do you avoid these pitfalls? How do you vet someone properly?
The book lays out some key criteria, things you should absolutely ask about. First, look at their credentials. Are they a certified financial planner, CFP? Does their team include specialists like estate planning attorneys or CPAs?
Okay, check the qualifications.
Second, confirm the firm doesn't push its own proprietary mutual funds or separately managed accounts. That avoids them steering you into their own high-fee products.
Makes sense. Keep it independent.
Third, verify they don't receive any third-party compensation kickbacks, essentially for recommending specific investments. Their loyalty should be only to you.
No hidden agendas.
And fourth, a really important structural point. Ensure your money is held by a large, independent third-party custodian, like a Fidelity or a Schwab.
Why is that important?
It provides a layer of security. The advisor doesn't directly hold your money. And it also makes it much easier to switch advisors if you're ever unhappy without having to liquidate everything. Your assets just stay put at the custodian.
Ah, okay. That provides safety and flexibility.
Exactly. The book mentions firms like Peter Malloch's Creative Planning as an example of one that meets these strict fiduciary criteria, and notes they even offer things like a free second opinion on your current plan.
So due diligence is key when choosing who to work with.
Absolutely critical. Now, we've talked a lot about the mechanics, the strategies, the advisors, but you might be thinking, okay, but what does my mindset have to do with my money?
Yeah, we touched on that earlier. How important is the psychology?
Well, the book argues it's, well, maybe everything, because if you get all the financial pieces right, but your mind's still in chaos, filled with anxiety or fear, you've kind of missed the ultimate prize, haven't you?
True wealth isn't just a number in your bank account.
Exactly. What's truly fascinating is the realization that financial freedom on its own doesn't automatically guarantee happiness or fulfillment. There's a quote in the book that really hits home. If you get what you want and you're still miserable, then you're really screwed.
Yeah, it's sobering.
It suggests that true wealth is much broader. It's emotional, it's psychological, it's even spiritual well-being.
This reminds me of that distinction the book makes between the art of achievement and the art of fulfillment.
Yes. Tell me more about that.
Well, achievement is about gaining clarity, focus, taking action to reach external goals, getting the money, the success, the recognition.
Right.
But fulfillment is the internal game. It's about joy, gratitude, peace of mind. And the book uses the tragic example of Robin Williams. Here was a master of achievement, right? TV star, loving family, immense wealth, an Oscar winner. He achieved everything you could possibly want externally.
Absolutely.
Yet internally, as we sadly know, he struggled deeply. So what does that tell us?
It tells us that mastering your internal state, your own mind, is paramount. It's maybe the most important skill of all. The book draws this powerful distinction between living in a beautiful state, feeling joy, gratitude, love, versus a suffering state, feeling anger, fear, frustration.
And we often fall into suffering without realizing it.
Our undirected minds often do. It identifies 3 main suffering triggers that our thoughts tend to latch onto, focusing on loss, less, or never.
Loss, less, or never. Explain those.
Loss is feeling you've lost something valuable, respect, love, opportunity, money. Less is the belief that something isn't enough, you have less than you need, less than others, less than you deserve, and never is the paralyzing idea that something you desire will never happen or something you fear will never end.
Okay, I can see how focusing on those would definitely lead to suffering.
Right, they're traps. But the good news is you can consciously choose to shift your state. You don't have to stay stuck there.
Oh, what are the tools?
One really practical, actionable tool is called the 90-second rule. When you catch yourself feeling stressed, anxious, angry, suffering, give yourself just 90 seconds. Let the physiological response run its course. But then consciously detach from those negative thoughts and intentionally shift your focus to something you appreciate. Anything.
Just pivot your focus.
Pivot your focus. As the book wisely says, what's wrong is always available, but so is what's right. You just have to look for it.
Okay, the 90-second rule.
What else? Another incredibly powerful yet simple tool is a 2-minute gratitude meditation. Just take 2 minutes, focus on your heart area, maybe put your hand there, and think of 3 things you're genuinely grateful for. Feel that appreciation deeply.
How does that help combat suffering?
Because the book argues you physiologically cannot be truly grateful and simultaneously angry or fearful or worried. The feelings are incompatible. Gratitude literally becomes the antidote to suffering. It changes your whole biochemistry.
Gratitude is an antidote. I like that.
It's powerful stuff.
Ultimately, then, it comes down to realizing our lives aren't just shaped by our circumstances, our conditions.
No, they're shaped by our decisions, especially the decision about what state we choose to live in.
And the most important decision.
The book argues it's committing, truly committing, to being happy no matter what happens externally. Choosing to live in that beautiful state, regardless of life's ups and downs, that's real power.
Wow. Okay, so we've built a solid financial foundation with the core 4. We've learned to manage fees and fear. We found a trustworthy guide. And we've even worked on mastering our minds. That feels pretty comprehensive.
It covers a lot of ground.
But there's one final crucial piece in there. Ensuring true peace of mind often involves protecting your legacy, making sure those you care about are taken care of after you're gone.
Yes, estate planning. It's not the most exciting topic, but it's incredibly important.
And sadly, even really famous, wealthy people overlook it. The book uses the example of Prince, right?
Yeah, a really stark example. He passed away unexpectedly without a will.
And the result?
Chaos. A staggering 40% of his estimated $300 million estate ended up potentially going to the government in taxes. And his assets were tied up in court battles for years instead of going smoothly to his intended heirs, his family.
40%. Just because he didn't have a plan, that really highlights how critical estate planning is.
It absolutely is. And it's crucial for everyone, not just the super wealthy. Regardless of your age or how much you have, having a basic plan protects your family from unnecessary stress, expense, and potential conflict.
So what are the absolute essentials?
At a minimum, everyone needs a power of attorney for healthcare and one for finances. These allow someone you trust to make decisions if you become incapacitated. And, of course, you need a will.
What needs to go in the will?
3 key things. Clearly name your beneficiaries who gets what. If you have minor children, you absolutely must name a guardian. Otherwise, a court will decide who raises your kids.
Wow, okay, that's critical.
Critical. And third, you designate an executor, the person responsible for carrying out the instructions in your will. The book also mentions something called testamentary trusts within a will.
What do those do?
They allow you to control how assets are distributed, especially to younger beneficiaries. So instead of an 18 or 19-year-old suddenly getting, say, $200,000 cash.
Which might not end well.
Exactly. The trust can specify that the money is managed for them and distributed at certain ages or for specific purposes, like education.
Smart. What about estate taxes? Do most people need to worry?
Honestly, for the vast majority of people, the answer is no. The lifetime federal estate tax exemption is very high, currently over $5 million per person, or nearly $11 million for a married couple.
So unless you have more than that, no federal estate tax.
Correct. But for those with truly large estates, above that threshold, a hefty 40% tax rate kicks in on the excess amount.
Yikes. So for wealthier individuals, planning is essential.
Yes, and there are smart, tax-efficient ways to give money away during your lifetime to reduce the size of your taxable estate. You can make annual tax-free gifts to as many individuals as you want, up to a certain limit each year. It was $14,000 when the book was written. It adjusts slightly.
Okay, that's one way.
You can also pay directly for someone else's medical bills or tuition. Those payments don't count against your annual gifting limit at all.
Oh, interesting. Good to know.
And of course, any money you give to qualified charities is completely free of estate tax.
What about trusts for asset protection?
Yes, trusts are powerful tools. A basic revocable living trust is very common. Its main benefit is that assets held in the trust avoid the time-consuming and public process of probate court after you die.
Okay, avoids probate. What about protecting assets from, say, lawsuits or divorce?
For that, you might look at an irrevocable trust, sometimes called an asset protection trust or an ILIT, irrevocable life insurance trust. This creates a separate legal entity. Assets moved into it are generally removed from your taxable estate and are protected from your personal creditors or claims in a divorce.
So, more complex, but more protection.
Exactly. An ILIT, for example, can own a life insurance policy, allowing the death benefit to pass to your beneficiaries completely income and estate tax-free.
Okay, that covers wills and trusts. What about insurance? That's part of protecting your assets too, right?
Definitely. Life insurance, first off. The book generally recommends term life insurance for most people, despite agents often pushing more expensive permanent policies.
Why term?
Because its purpose is typically to replace your income and safeguard your family financially until you achieve financial independence, perhaps until the kids are grown or the mortgage is paid off. Term is pure protection for a set period and much cheaper.
Got it. What else?
Disability insurance is vital. Think about it. Your ability to earn an income over your career is often your single greatest financial asset. Disability insurance protects that income if you get sick or injured and can't work.
Often overlooked, but really important.
Hugely important. And then there's long-term care insurance. This is becoming increasingly critical.
For nursing homes and assisted living.
Exactly. Statistics show that about 70% of people over 65 will need some form of long-term care, and the costs are astronomical, easily $67,000 to over $168,000 per year.
Wow. That can wipe out savings quickly.
It can devastate a family's finances. The key with long-term care insurance is buying it relatively early, maybe around age 45 or 50. The premiums are much lower then, maybe $100 a month versus becoming almost unaffordable if you wait until your 60s or later.
Plan ahead for that one. And homeowners.
Quick point on homeowners insurance. Make sure your dwelling coverage amount is enough to actually rebuild your home if it's destroyed. Not just market value, but rebuilding cost. You generally need coverage for at least 80% of the replacement cost to avoid co-insurance penalties, where the insurance company wouldn't pay the full amount of a partial loss.
Good tip. Check that policy limit.
Definitely check it. So, after all these practical steps, the financial strategies, the mindset shifts, the estate planning, the insurance, what's left? What's the ultimate secret the book reveals to being truly unshakable?
Is there one big secret?
The book concludes with a profound truth, often echoed by the most successful and fulfilled people. The secret to living is giving.
Giving. How does that relate to finance?
It relates to everything. The true titans, people like Sir John Templeton, didn't just focus on earning. They were often immense givers, philanthropists. Templeton himself believed the real secret to wealth was gratitude, which naturally leads to giving. And this isn't just for the super rich. The principle applies even if you start by giving just a dime out of a dollar, as the book suggests.
So it's about the mindset shift it creates.
Exactly. The act of giving consistently shifts your mindset away from scarcity, from focusing on what you lack, towards abundance. It trains your brain to recognize that there's always more than enough for you and enough to share. There's more available for you to give, to appreciate, to love.
And giving isn't just about money.
Not at all. It extends to giving your time, your talents, your energy, your love, your compassion, your heart. The book emphasizes that nothing enriches our own lives as much as genuinely helping and contributing to others.
That's a powerful way to tie it all together.
Yeah.
From practical finance to profound purpose.
It really brings it full circle.
What an incredible journey this has been, really unpacking Unshakeable. We've gone from the nuts and bolts of finance understanding fees, navigating market volatility, building that solid playbook with the core four, to exploring the profound psychological side, mastering your mind, shifting out of suffering into a beautiful state, and then securing your legacy through planning and protection.
Yeah, it covers a lot.
All of this gives you, the listener, just an amazing edge. It vastly enhances your ability to stay clear-headed, to make smart decisions, even when things feel uncertain out there. You really do have a proven pathway to financial freedom laid out.
And perhaps even more than freedom, to being truly unshakable. You know, if you can learn to ride that roller coaster of life, the financial markets, everything else, and actually learn to enjoy both the ups and the downs, Well, then you are utterly unshakable, aren't you? This mastery of your internal state, regardless of what's happening externally, that's arguably a far greater achievement, a far richer treasure than any amount of money in the bank. So the question to leave you with is, how will you choose to define true wealth in your own life, starting today?
A perfect thought to end on. Thank you for joining us on Duo Reads.